When you hear the news talk about the Federal Reserve lowering interest rates, it can sound like a distant technical thing that only bankers care about. But if you've ever thought about buying a home, refinancing your mortgage, or just wondered why borrowing suddenly feels more expensive, you've already felt the impact. The Fed, mortgage rates, and the bond market are like three gears in the same machine. When one turns, the others shift, sometimes smoothly, sometimes with a jolt. In today's video, we're going to unpack how these gears work together. We'll start with the Federal Reserve and its famous federal funds rate, then move into the bond market and why investors' decisions matter, and finally connect the dots to mortgage rates, the number that determines how much you'll really pay for a home over time. By the end, you'll see that mortgage rates don't move randomly. They follow patterns tied to expectations about inflation, growth, and risk. Part 1. The Federal Reserve and the Fed rate. The Federal Reserve is often described as the central bank of the United States. Its job is to maintain economic stability by keeping inflation in check, while also making sure the economy has enough room to grow. The main tool it uses for this is the federal funds rate. The federal funds rate is the interest rate banks charge each other for overnight loans. It might sound like a technical side note, but this rate sets the tone for all short-term borrowing in the economy. When the Fed raises the federal funds rate, borrowing money gets more expensive. That filters down to credit cards, car loans, and business loans. When the Fed lowers the rate, the opposite happens. Money flows more easily, businesses expand, and consumers spend more. But here's something crucial. The federal funds rate is a short-term rate. Mortgages, on the other hand, are long-term commitments, often 15 to 30 years. So the Fed doesn't directly control mortgage rates. Instead, its actions create expectations that ripple through the financial system and end up influencing long-term rates in an indirect but powerful way. Part 2. The bond market and Treasury yields. To understand mortgage rates, you have to understand the bond market, especially U.S. Treasury bonds. A bond is essentially a loan. When you buy a Treasury bond, you're lending money to the U.S. government in exchange for interest payments over time. Among all the Treasury bonds, the 10-year Treasury yield is the star of the show when it comes to mortgages. Why? Because the average homeowner doesn't keep their mortgage for the full 30 years. Most sell, refinance, or move within 7 to 10 years. That means the 10-year Treasury is the closest benchmark for how investors value a typical mortgage. Here's how the mechanics work. When investors pile into bonds, the price of those bonds goes up and their yields go down. When investors sell off bonds, prices fall and yields rise. It's a constant tug of war. And what pushes investors one way or the other? Expectations about inflation, economic growth, and risk. If investors believe inflation is going to rise, they demand higher yields to protect their money's value. If they think the economy is slowing down, they buy bonds for safety, pushing yields down. If the Fed is raising rates aggressively, investors may anticipate slower growth in the future, which again affects how much they're willing to pay for bonds right now. This is why you often hear that mortgage rates follow the 10-year Treasury yield. They don't move in lockstep every day, but over time the connection is undeniable. Part 3. Mortgage-backed securities and mortgage rates. Now, let's bring mortgages into the picture. Mortgages themselves are turned into financial products called mortgage-backed securities. These are bundles of home loans sold to investors who receive interest payments as homeowners make their monthly payments. For investors to buy these mortgage-backed securities, the yields need to be attractive compared to safe alternatives like Treasury bonds. That's why mortgage rates usually sit about 1.5 to 2 percentage points higher than the 10-year Treasury yield. The extra margin compensates investors for the added risk of lending to individual homeowners rather than the federal government. This spread, or the difference between Treasury yields and mortgage rates, can widen or shrink depending on market conditions. In times of financial stress, investors may demand a higher premium to hold mortgage-backed securities. which pushes mortgage rates higher even if Treasury yields haven't changed much. Part 4. How the Fed, bonds, and mortgages connect. Now we can tie it all together. The Fed sets the federal funds rate to influence inflation and growth. When it raises rates, borrowing in the short term becomes more expensive. This makes businesses and consumers slow down, which in theory should bring down inflation. But what happens in the bond market? If investors believe the Fed is serious about controlling inflation, they may actually feel safer buying bonds, which pushes Treasury yields lower. In that scenario, long-term mortgage rates could stabilize or even drop despite the Fed raising rates. On the other hand, if inflation remains stubborn and investors don't think the Fed can get it under control, they'll demand higher yields on bonds. That drives Treasury yields up, and mortgage rates rise right alongside them. This is why you sometimes see mortgage rates rise even before the Fed announces anything. The bond market is forward-looking. It reacts to expectations, not just to current policy. Investors are constantly asking, where will inflation be in 6 months, in 2 years? Will the Fed keep raising, or will it cut? Their answers to those questions show up in bond yields, and from there, in the mortgage rates offered to everyday homebuyers. Part 5. Real-world example. When the Fed lowers rates. Imagine the economy is slowing down. Businesses aren't expanding, consumers are cutting back, and unemployment is creeping higher. In this environment, the Federal Reserve might decide to lower the federal funds rate to stimulate growth. When the Fed cuts rates, borrowing in the short term becomes cheaper. Businesses can access loans at lower costs, and consumers might see credit card rates and auto loan rates start to ease. The idea is to encourage more spending and investment to get the economy moving again. Now, here's where the bond market steps in. Investors ask themselves, if the Fed is cutting rates, what does that mean for inflation and growth in the future? If they believe the rate cuts will succeed in stabilizing the economy without fueling runaway inflation, they may actually accept lower yields on bonds. Buying activity in treasuries goes up, yields fall, and with them, mortgage rates may also decline. But there's a twist. If investors worry that the Fed is being too aggressive, or that cheaper borrowing will eventually push inflation higher, they'll demand higher yields to compensate for that future risk. In that case, Treasury yields might not fall very much, and mortgage rates could stay elevated or even rise, despite the Fed's cuts. For homeowners and buyers, this tug-of-war means that a Fed rate cut doesn't automatically guarantee lower mortgage rates. Instead, it sets off a chain reaction of expectations, debates, and decisions in the bond market, which ultimately decides whether those lower rates reach Main Street. Conclusion. The federal funds rate, the bond market, and mortgage rates are 3 parts of the same financial ecosystem. The Fed controls short-term rates, setting the tone for borrowing across the economy. The bond market translates those signals into long-term expectations, especially through the 10-year Treasury yield. And mortgage rates follow the bond market, adjusted for risk, to determine how much homeowners actually pay. So next time you hear about a Fed rate hike or a sudden move in the bond market, you'll know exactly how it could impact the roof over your head. If you enjoyed this video, please give it a like and subscribe to this channel. We'll keep sharing more personal finance-related news, insights, and tips that I'm sure will help you. Thank you very much.